Okay, good afternoon, everyone. Thank you so much for taking the time this busy Thursday afternoon. So, we've been marketing this for the last probably 10 days or so. And if you were at our expo, you also had a chance, I'm sure, to listen and possibly meet Mary Reed, our keynote speaker. And basically, what happened, to make a long story short, we had over 250 agents from all over the country at the expo, during a pandemic, which, speaks volumes about Mary and us. And, we're still bringing the sales ideas, the great concepts, the networking. And I think that it was a day that everyone walked away with nuggets. But here's the takeaway. We had, let's see, 11 presenters, right, including Mary. And I would say 70 to 80% of the audience, we sent out a survey. They said, Bill, we loved everything, but we need to talk to Mary. We need to hear more. We want to talk about sales strategies, or I have a guy, I have a girl. So we decided to bring Mary back on to the webinar weekly training series that we host weekly, sometimes twice a week. And Mary agreed to do a part one, part two version so we can make sure that everyone had everything they needed to go out and be dangerous and hopefully make one of these large case sales. Okay, so that's what this is today. This is our part two version. And also, when we sent out these surveys, obviously it was to the agents in the audience, and we have over 21,000 agents across the country. 250 plus agents were at the expo. So that means most of the agents, unfortunately, couldn't make it down. So when we spoke to Mary about the part one and part two, we said, let's open this up to all of our agents because, again, everybody will pick up a nugget or two or three, right? That could change your year. Okay. In fact, it could change your career. Okay. This could open a new door to a business owner. It can open a door to a CPA, estate planning attorney, whatever the case is. That could be life-changing because, like I said, these cases are monsters. And, I just want to say a couple things, and then I know Mary has a lot to say, and I always cut her short, which I do not want to do today. She's also from New Jersey, and I'm from Miami, so she's a tough cookie, and I'm a little scared of her, so we're going to make sure she has her 50 minutes. But anyway, yeah, I think it's so important that you understand, right? You're out there in the field, Cedar Rapids, Iowa, Lincoln, Nebraska, Fort Lauderdale, Florida, wherever you are, and you're focused on, third bedroom term sales, right? Or fourth bedroom final expense sales, or, maybe estate planning IULs that are 10 million and up. It doesn't matter. Okay, here's the point here. Learn enough to be dangerous, right? To figure out, do I have that guy or girl in my database? Okay, do I have that neighbor or family member that this could be a possible fit for? Okay, here's why. You don't have to have 17 different designations after your name on your business card to sell one of these. Okay, and here, in my opinion, the icing on the cake, Mary, if you have a possible case, right, and the client is a good fit with her strategy, and she'll talk to you about it, by the way, right, she will jump in and literally make the sale with you, okay, and do the heavy lifting. You will obviously do it together. She's not going to steal your client, okay. In fact, you still get the majority of the commission, and your name is obviously agent of record. So there's no gray area, okay, but you don't have to know everything. In fact, if you just know the right person, okay, average case size, 130 to 200 grand of target premium. If you know the right person, they say relationships are everything, right? She, again, will do the heavy lifting as you're learning and you're both on the phone or webinar with your client. So that's what I love about all of this. You don't have to be the rocket scientist. And if you are, by the way, and you want to handle everything yourself, that's great too. And Mary can talk to you before the call or the webinar and prepare you. And you can go make the sale on your own. No problem. Okay. Now, just a couple other things If you're focused on business owners, right, and you love these distribution solutions, tax saving strategies, maybe assembling IUL with the purpose of retirement and cash accumulation in mind for the consumer, great. Okay, great. But with Mary's books and her platform and these trainings, this is even going to take you to a new level. Okay, we have a section on our website with all of this information. We're also giving away her prospecting book. Okay, which also, these work great, by the way. If you want to hand them out to your consumers, they're done in layman's terms, and they literally will tee up the appointment for you, and then it's up to you and Mary, if you want to get her involved, to make the final sale. Okay, but these work great. We're giving away the prospecting book, and we're giving away the Fire 8 new Amazon tablet to the winner of today's question of the day, which we're going to do as soon as we wrap up at the end here. So make sure you stay on till the last minute, okay? And hopefully you'll be the winner. We'll announce your name as soon as we figure out who's first and correct. Okay, let's move forward here. Enough of my ranting. Today's not about ranting. It's about Mary and you all. So Mother's Day sales contest, okay, one of my favorite days of the year. Everybody, if you know me pretty well, you know how close my family is, how close I am to my mom. In fact, I went to the Formula One race in Miami on Saturday for the qualifying day, and I missed Sunday, the main race. Why? To spend it with my mom. Okay, and I'm blushing a little bit, but anyway, the point is we take it very serious here at Levinson, right? If it wasn't for our moms, we wouldn't be here today. So we wanted to do a Mother's Day contest, and this is for everybody, by the way, okay? All of our agents, very simple. You write 5 apps, 4 weeks. Whoever gets there first wins. We have $1,000 tech package. Andrew, if we can mute that line, getting a little keystroke noise there. Thank you. Okay, so this is over $1,000, including a 3-month subscription to our new Ringy CRM platform. So everything that you're looking at in front of you, again, 5 apps, 4 weeks. We'll announce the winner on Facebook. And this is every company, annuities, life, supplemental products, cancer, CI, all the above. Again, make sure that you follow our Facebook page because hopefully you'll see your name pop up there when we announce the winner in just, about 3.5 weeks away. Okay, let's move on to the next slide here. What's new at Levinson? So we got a bunch of hot new product sales strategies, bonuses, cash, giveaways, all the above, okay? A couple of my favorites I'm going to point out. We just launched the Expo video, okay? So if you were not there, or even if you were there, you want to see yourself on camera, we have a 6-minute highlight reel that came out amazing. My favorite one to date. We're going to include it in today's thank you email, so check that out when you can. Also, talking about nuggets, right? The Ringy podcast episode was launched last week, and I hosted this with the CEO and then the head of sales and marketing at Ringy, but an unbelievable story, and they share some great agent success stories that you want to listen to, okay? And you want to write down some of these notes and see what these agents are doing in the new year here, right, in 22, and moving forward by leveraging the latest technology in this dinosaur life insurance space. Okay, because that's the hot ticket. If you can figure out, you already know the products like the back of your hand, right? And if you can learn about some basics on the tech side, right, and then you have Mary's knowledge as your third prong, going out there into the space, to this consumer bucket, you put all these 3 things together, you're off to the races, right? You got to figure out a way. After you hear Mary speak, you're going to hear some great strategies, and you're going to say to yourself, how am I going to drum up some new prospects and turn them into leads so I can discuss this new concept, okay? And by leveraging some of this technology, you can do exactly that. And I'm going to show you 2 agent examples that did exactly what I'm talking about, and the numbers are astonishing. It's crazy. So anyway, you got to check out that Ringy podcast. It's a game changer. 30% off for all Levinson agents. Okay, in front of you is what's new at Levinson. We have a bunch of bullets here in front that I'm not going to go over right now because it's going to take way too much time, and I want Mary to have her slot. So we will, in fact, Andrew, make a note. We will include this in today's thank you email. We'll also give you everything that you need to get started with Mary's strategies as well. Okay, so make sure you look out for the thank you email. Okay, let's move forward here without further ado. We're doing things a little different today. We're jumping right into our featured presentation. We have my friend, Miss Mary Reed, is joining us. Sit back, relax, take plenty of notes, use that Q&A box for questions and answers, and Andrew's going to fire away. As soon as you type in a question, if we need Mary, we'll get Mary involved at the end, and then we'll answer every single one that comes in. So Mary Reed, are you there?
I am here. I am here. Thank you very much.
Yep. Thank you.
All right. So let's dig into it. So that was great. And Bill had lots of great ideas there. And I would just repeat before we get into this, just exactly what he said. I'm here to help you so that as we go through this, think about people that you know, think about contacts you know, of people who might be candidates for this strategy. And all you need to do is open the door. And I will do the heavy lifting and help you through the whole way and move the case forward. So with that, let's dig into it. So today's topic is the distribution strategy. So this is for people who have already accumulated money in qualified accounts, right? Our last call was more about how you accumulate the money. This is about getting the money out. So these people are everywhere. You know, you can see here, $33 trillion is sitting in qualified accounts in this country. That is a huge number. You know, you go into any room full of people and ask who here has an IRA. It's going to be almost everybody in the room. Who has a 401k? Almost everybody in the room. You know, people have these accounts in one form or another. Now, that doesn't make all of them candidates. We're looking for the people with the larger balances. And when I say larger, typically here we're working with people with balances of $500,000 or greater. There are always exceptions. We do some smaller ones, but the more money people have in these accounts, the more of a candidate they become. And why is that? Well, everybody loves putting the money into these accounts tax deductible. That's why people put money into IRAs and 401ks and defined benefit plans and 403b plans, right? It goes in tax deductible, you know, with the one little exception of doing a Roth 401k deferral. But people love the tax deduction and they love the tax deferred growth, and they hate paying the taxes when it's time for the money to come out. And so the more money that someone has in one of these accounts, the bigger tax bill is looming ahead of them. And so that is what we are here to help them with. With this strategy that we're going to go through today, we can help them get control of that tax bill and get it down. So here's the problem, right? If I have someone here who has $1 million sitting in their account, let's just say it's in an IRA, they bring you the statement. They think they have $1 million. They feel really good about that. Look, I've got $1 million, but they don't really, because every time they take a dollar out, they have to pay tax on it. So I'm using at the top federal rate, and I happen to be using North Carolina state tax rates here. They're a nice middle of the ground state. That $100,000 million really has a tax lien sitting on it of over $422,000. So even though the statement says $1 million, they really only have $577,000. That's a big difference, and a difference that a lot of people haven't really thought through. They start to feel that pain when they take the money out. You know, if someone needs money for something, you know, they want to take out $10,000. Well, maybe they have to actually take out $10,300 or rather $13,000 to net that $10,000, or maybe $14,000, depends what tax rate they're at, and that makes that money go much more quickly than they had thought it would do. The other side of the equation is the people who don't need the money, right? And then they get to age 72 and they have to take those required minimum distributions, and they hate that. Because it's just additional taxable income that they don't really need, and it just ups their tax bill. So, you know, this money is going to be taxed. It's a question of how much and when. Now, there are some other things happening. You know, I just like to keep people aware of these things. You know, there's $33 trillion sitting in those accounts. Congress does not forget about that money. They look for tax revenue. That's a bucket of money they haven't received taxes on yet. So they come back to it from time to time when they're looking for tax revenue. We had these provisions in the Build Back Better Act. Now, it didn't go through, but we're expecting these to resurface. There's been some talk about them actually recently. Excuse me while I eat a cough drop here. I've been sick for 5 days and I'm coughing like crazy. I'm trying not to cough on you. I apologize if I do. So one of the proposals was to eliminate the Roth conversion option for people who have income over 400,000 or 450,000 if they're married. Now, think about that for a second. You know, 450,000 is a nice income, but it's not super wealthy. There are lots of parts of this country where that would be a nice upper middle income, which means there are a lot of people that fall into that category. So if you take the Roth conversion off the table, what's left? Let's say someone has money in an IRA right now. They see two choices. Leave the money in the IRA, let it keep growing tax deferred, maybe for as long as possible. They'll have to take their required minimum distributions at age 72 and then pay the taxes accordingly. Or they could do a Roth conversion. Well, what do they have left if Roth conversion gets taken off the table? They've got nothing, except we offer a third solution. The other thing that's been proposed is to close the backdoor Roth. This is a strategy where individuals contribute after-tax money into a 401k plan and then immediately convert it to Roth. And it's a way to getting a big Roth contribution, circumventing the Roth IRA rules for compensation. So we'll see what happens with these, but these have resurfaced and they may affect clients of yours who have incomes above those thresholds. So as I said, most people, you know, they have two choices. Let the money keep growing tax deferred or do the Roth conversion. The third option we're going to offer uses safe harbor rules that the IRS gave us. We're using the life insurance here. And the reason we're using life insurance is that whenever we take dollar out of a qualified account, we're taxed on that dollar. It's always ordinary income. We can't make it long-term capital gains. You take out a dollar, you pay tax on that dollar, whatever your tax rate is at that time. There is one exception and only one exception to that rule. And that one exception is if that dollar is sitting inside a life insurance contract and we distribute the life insurance contract, we're taxed not on the dollars we put in that contract, but what the IRS defines as the market value of the contract at the time of distribution. So we can use that to our advantage. If we use a contract where the market value, mind you, it's not cash surrender value, it's a different calculation, it's market value, is lower than the cash put into the policy, then we just had some tax arbitrage there because we will have reduced the tax bill. So that is a big part of this strategy. It's not the only benefit of this strategy, but that's usually the main starting point. It's about tax savings. It also addresses market risk. If someone has their IRA or their 401k or whatever invested in the market, they have the risk that goes along with that. They may make money some years and they may lose money in some years, but they're carrying that market risk. They also hold on to the risk of increasing tax rates, right? The longer you leave that money in that account before you distribute, the higher the risk that tax rates will change. I personally, and I don't know anybody else either, who expects tax rates to go down over time. I think they're much more likely to go up. So if you delay, you're holding on to that risk. We will address that as well because we will do this as a 5-year strategy. And at the end of 5 years, we will pay the taxes and we will be done with our tax bill. And it doesn't matter what happens with tax rates after that, this money will be unaffected. And then of course, there's longevity risk. People worry about outliving their money or maybe just having enough left to pass on to their beneficiary. We can address both of those by using the life insurance. All right, so let's start, with someone who's got that money in a qualified account. If they're in the delay mode, right, we're also programmed to defer. Keep deferring taxation, keep deferring. Well, when you hit age 72, you have to take your required minimum distributions. So I've just taken the R&D table here, abbreviated it, and converted that to a percentage because most people don't really know what the factor means. So at age 72, the factor is 27.4. That translates into you have to withdraw 3.65% of your account. At age 80, it's 4.95%, and this percentage keeps climbing because the table is designed to empty your account by the time you die. So then if we go one step further and say, okay, if I have to withdraw 3.65% of my account, how much do I have to earn on what's left to replace what I just took out? Because maybe I don't want to eat away at my principal because I don't want to run out of money. Well, if that's the case, I have to earn 3.79% on what's left to replace what I just took out. Now, of course, as the withdrawal percentages climb, so do the rates that I have to earn on what's left to replace what came out. So at 85, if I have to withdraw 6.25% of my account, I have to earn 6.7% on what's left to replace it. So this tells us a couple of things. Two things. Number one, kind of the standby rule of thumb that's been around for so many years now, that's still around, that says, well, you know, when you get to retirement, withdraw 4% of your account and you'll be fine. Well, we don't have that option. We don't get to withdraw 4% of the account, not by the time we're 75 anyway. We're forced to withdraw more. The second thing that tells us if we're concerned with preserving the principal, we're going to have to invest in the market. We can't get these rates of return sitting in CDs or treasuries or something very conservative. So if we're forced to invest in the market, that means we get the risk that comes along with that. Here's a look back to the drops in the market from the peak to the trough when it took a big drop going back to 1900. And you see these are very, very big drops. Now, it's one thing if the market takes, you know, let's call it a 63% drop and I'm 25 and I've got a long time for that to recover. It's quite a different experience if I'm 75. You know, the older we get, the higher the risk of the order of the returns becomes, and the harder it is to have time to recover. So just to give you a little example here, if I had a 72-year-old and they did a blended portfolio, trying to be conservative, 60%, 40% blend, and I used the actual returns of the last 10 years and applied them, if they started with $1 million, between what they had to take as the required minimum distributions and the performance of the money, by the time it's 10 years later and they're 82, they'll only have $619,000 left. And remember, that's pre-tax money, so every time they need $1, they're going to have to take out $1.30 or whatever it is. That could get to be kind of a frightening amount of money, depending on how long they might live. But that is what will happen if that account just keeps getting eaten away. So here's another look. I'm going back on the S&P 500 to 1900. And this is showing, yes, over time, the market does grow. But when it takes one of these big drops, it can take a long time to get back to break even. We see here it was 14 years, 23 years, 29, 26. And again, if I'm young, that may not be such a big concern. But as I get older, do I have 14 years to wait for it to recover? Number one. Number two, if I hit 72 and I have to take my money out, I don't get to let it sit there and recover. Number three, if it goes to my beneficiary, now under the Secure Act, if it's anybody other than my spouse, they're going to have to empty the account in 10 years, so they don't get to let it recover either. So this becomes an increasing risk. By going to the life insurance, we protect them from this risk, right? If we're using the Index Universal Life, it has the floor of 0. So now when the market drops, we don't go with it. We stay where we are. We still want the upside potential, certainly, but it protects us from this downside risk. And we talked about the Secure Act, right? That 10-year rule really increases that risk for our beneficiary as well. All right, so what does this strategy do? It reduces the taxes. It'll be a significant reduction, and we'll get into the numbers in a second. It can increase the tax-free legacy to beneficiaries because this is, after all, life insurance. It will remove the money from that R&D requirement because after 5 years, we will get it out of the qualified plan. And now we're not under those IRS rules anymore, right? As long as the money stays in the qualified account, the IRS is in charge. They're telling you when you have to take it out and how much tax you're going to have to pay on that money. They tell you, and they tell your beneficiary when it has to come out. By doing this, we get it out from under those rules because we're no longer in the qualified arena anymore, so that that client can use the money how they want, when they want. We can reduce or sometimes even eliminate, if we go to whole life, the market risk on this money. And we're going to add the tax-free living benefits as well, which is a benefit they don't have at all, as long as they stay in their IRA or the qualified account. So let's look at a 55-year-old. This is a 55-year-old with $1 million in their account. If we look ahead, and nobody does this, by the way, nobody has this conversation with this account owner. Let's say somebody meets with this person, they bring out their statement, I have $1 million. Good for you. If they keep that $1 million in their account, never mind if they're adding to it, I'm just looking at the $1 million and we let it grow over time, and they were to die at age 90, they would have had to take required minimum distributions starting at age 72. So if I add up the tax on those distributions, plus the tax that will ultimately be due on the remaining balance that'll be paid by their beneficiary, the tax bill on that account is $1,392,000. Now, they have probably never looked at that number, seen that number, or thought about that number because they only have $1 million in their account, and they'll go, well, how could that be? Well, because all the growth on the money will also be taxable. If they did our life insurance strategy instead, the tax bill would be $385,000. So for this person looking out to age 90, we're saving them $1 million in taxes. I would call that a pretty significant savings. Now, if we compare it to a Roth conversion, if we started with $1 million in the account, and let's grow it for 5 years to compare the tax in the same years as we would do the life insurance, that account would grow to $1,260,000. We take it out and pay the tax, and the tax due is $532,000 and change. If we put the $1 million into the policy, it's buying this death benefit up here, this $2.225 million death benefit, which is there from day one. But they get to year 5, we finish paying for the policy, we distribute it. Now, for the tax purposes, the value is that IRS market value calculation, which on this policy is $911,616. So now the tax bill is $385,000. So in both strategies, we've taken the money from being in a highly taxable position to a tax-free position. But by doing it with the insurance instead of the Roth conversion, we saved $147,000 in taxes. All right, so let's take a look at the bigger picture here. So here's my 55-year-old. These new numbers here are with the new Summit product, by the way, on the screen now. So here's my same 55-year-old with $1 million. I'm running this with Summit. Now I have to make some assumptions here on the IRAs. I'm assuming here that they will grow at a net annual compounding rate of 4.74%. Now that sounds low, but where that number comes from is it's the actual S&P returns for the last 20 years, assuming a blended portfolio, 60% stock, 40% bonds, using the current bond rates. And then I take a 1% management fee off because that's typical, and that actually brings me to that 4.74% number. Recognize that is not an average. An average number would be higher. This is an annual compounding rate. And then I have to use a tax rate. I'm using combined state and federal here to be a total federal 37 plus state that brings us to 42.25. So let's see what happens. So now using these assumptions, I take that $1 million, I'm growing it at this rate. I grew it a little higher than the number we just saw because I'm using current numbers now. This is the actual, I updated this recently with a new 20-year. That tax bill, if we look out to age 90, right on this $1 million, taking the RMDs from age 72 to 90, plus the tax on the balance of the account, now that tax bill is $1,684,000. Which, by the way, if you have a client who says, well, I can earn more than that on the money. Well, maybe, maybe not, but good for you. But if you do, what happens to this tax bill? It just gets bigger. If we did the Roth conversion here, the tax bill is $532,000. If we do the life insurance with the new Summit product, the market value calculation on that brings the tax bill to $385,000. So you're going to pay tax on this asset sometime. The question is when and how much. Which of these tax bills would you rather pay? Most people would go with the lower one. All right, so now let's go to the benefit side of the equation. If we're losing benefits, then we're not necessarily coming out ahead. So if we put this million in the policy, we're doing an annual premium of $200,000 for 5 years, and we just let that death benefit be, didn't take cash out of the policy, and now this person dies when they're 90, the death benefit to go tax-free to their beneficiaries is $5,294,000. But they could also use the policy for income. So if they wanted to use this for income, I ran this illustration, and run it however you want. You know, everybody's making different choices, and I'm not saying they have to use the money this way. I just said, what if we want an annual income from this policy? And I'm starting it in 10 years at age 65 to take this money every year till this person's age 100. I'm running the policy to 120. I'm not collapsing it. I'm just running the income to age 100. And with that assumption, we could pull out $97,798 a year tax-free. So now they're getting almost $98,000 of tax-free income every year. Doesn't affect their Medicare premiums for their IRMA tax, doesn't affect the taxation of their Social Security, might be able to keep them in a lower tax bracket depending on what other income they have, and it's all tax-free money. Now, if I make that assumption, but then they die at age 90, I add up this $97,000 every year from age 65 to 90. Plus, and then I add the remaining death benefit that would go to the beneficiary, and the contract pays a total of $2,927,000 tax-free. Now, if we had done the Roth conversion, we could pull out the same $97,000 tax-free, right? Both are tax-free. Now, I had paid a higher tax bill to get there, but I could pull it out tax-free. And if I do that with my assumptions, the Roth pays a total of $2.2 million. The traditional account does the worst, because to pull out this $97,000, I have to gross that number up, pay the tax to net the $97,000, and I pay so much in taxes that after tax I'll end up with $1,167,000. So I have lowered the tax bill and increased the benefits and reduced their market risk. Now, what if the market actually turned negative a few years, right? If they're in the IRA or the Roth and they're in the market earning those returns, well, what if they had a few years where it just went down? So I put in 3 negative 10 years of return here. I spread them out 15 years apart. I do the first one in year 6 and then the next two 15 years apart, right? The life insurance policy has the floor of 0. So when the market goes down, we don't lose any money. We don't get a positive credit that year, but we don't lose anything. Whereas if they were in the market with the IRAs, they would go down with the market. So if that were to happen, this 2.2 million drops down to 1.4. The 1.1 goes down to 892. That's the risk they're holding on to if they stay directly in the market. And that's a risk we can help protect them from. Now, we also have the living benefits, right? They don't have these at all if they stay in the market or stay in their IRA, but they do with the life insurance. This policy happens to be at the maximum. And to give this person an idea, right? So people know long-term care is expensive, but they don't know how expensive. This is North Carolina. I have this for every state. In 2009, the average rate for a semi-private room was $84,680. Historically, we've seen an inflation rate on these expenses of 3%, and the average length of care, this is all from federal statistics, is 3 years. So if this person were to get sick at age 90, they're looking at a potential expense of $736,000. Now, if they don't have any long-term care insurance, this is going to have to come out of their assets somewhere. But if they had put the life insurance policy in place, they have these living benefits to draw on. That could protect them in the event that that were to happen. And again, if they never need it, great, never need it, it will go in the death benefit to your beneficiary, but that money is there if they need it to cover those expenses. And that is an added protection we're giving them that they wouldn't have otherwise at all unless they bought themselves long-term care insurance. So I just wanted to show you a little glimpse here. These are the spreadsheets I use to do all these calculations. And I know it's a lot of numbers on the screen, but we don't usually go through these with the client, although we share them with them. But I did want to show you the one page that sometimes clients want to see. The left side here is the life insurance illustration. This one you can see is purely death benefit. no income coming out. The right side is the IRA. This just has the IRA with the RMDs coming out starting at age 72. This is that $1 million account. The first RMD is $85,000. But on this next page, this is where we take the income from the policy. So we can see this income coming out every year. You'll see the death benefit going down because we're pulling out this income. But what I wanted to show you here, and sometimes we do show this to the client if they want to use this for income. Remember, we just saved them, if we looked at to age 90, don't forget we saved them $1 million in taxes. Just want to put that out there. How big a return would you have to get on your money to make up for that difference? An awfully big return. That's one way to look at it, but here is another. If I want that income stream, I'm pulling it tax-free out of the life insurance over here. If I wanted to pull that out of my IRA, I have to gross it up with my tax rate here to $169,000 to pay the tax to net that same $97,000 of spendable income. And you see here where we go down to all these zeros, I have completely run out of money. Whoops, it just changed pages. Go back, go back. Go back up. There we go. I have completely run out of money by the time I'm age 77. There's nothing left in this account. It cannot sustain that kind of withdrawal. And yet the life insurance side, I've got this income running to age 100. I know I only have 92 on the screen because there was always so much space, but it's running all the way to age 100, and this policy is going to age 120. We do it as a Roth analysis too. Now the Roth lasts longer. We paid more tax to get there, but the Roth also runs out of money. Now it's made it to age 87. Mind you, this is without any losses. If I run this, and I would include this with the losses, you will see it run out sooner. The life insurance keeps going. All right, so here's the structure of this. We have to buy this insurance inside a qualified plan. So that will be a 401k or a profit sharing plan. So the question is, when you think about a client or you think about a prospect, do they own a business? If they do, we can set up a plan for them or use a plan they may already have in place. If not, can they generate some income on a Schedule C? Doesn't have to be a lot. $4,000 or $5,000 will do it. Could be from any kind of business enterprise, anything from driving an Uber to being a consultant. Can they do that? If they cannot do that, can a family member do it? Can a spouse do it or a child do it? And then we'll put the account owner on the payroll and get them in the plan. We do need this structure to make it work. So that is part of the conversation. Usually sooner rather than later, you know, is there going to be a way to get that earned income so we can set up that little 401k or profit sharing plan? Most of the time, this is not something that stands in the way. Occasionally it is, so we always want to go down this conversation with the client, but usually it does not get in the way. All right, now the big elephant in the room always is paying the tax, right? It's not tax evasion. We're not going to jail. It's tax advantage, but they will have to write that check in that 5th year when we distribute the policy. So where does that come from? Well, it's different for every client. Maybe they can take it from other assets they have. Maybe they can save money over the next 5 years to go towards paying that tax. Sometimes we'll leave money behind in the IRA or the qualified account that we'll then later draw down to use to cover the tax so we don't go into any other asset. We can take a loan from the policy. There's plenty of cash in the policy. So we could take a loan. Not my favorite choice because it will impact the future benefits, and we just reposition all that money to grow and work for them tax-free, but it is an option. If they have a business that buys equipment, they could time an equipment purchase to be in the same year that we distribute the policy, so they'll have a deduction to offset the tax. Same thing with charitable contributions or certain types of investments. So it can be any combination of these things, and every client is different. It is a conversation that we will have at some point. So it is something they have to be aware of, and this will be the biggest hurdle that stands in the way. People see that tax bill and they're like, how am I going to write that check? Well, remember we started in the beginning. This is not a matter of paying tax and not paying tax. This is a matter of which tax are you going to pay. One way or another, they're going to have to come up with the money. This is the least amount of money that they would have to come up with. So just one other glimpse, and we did this on the last call. We did the first half of this, and now we'll put both pieces together. Some different ways to use this strategy. We can use someone's account to buy insurance on them or anybody they have an insurable interest in, including their spouses and their children. So it's very common that we will split the money up frequently between spouses so that they both have the living benefits. But sometimes we will also use children because it's really about legacy. Excuse me. So this is a client where we did that. This client actually won a tax deduction. They owned a business, husband and wife, just the two of them. And they actually came to us looking for a tax deduction because after all, I do those, right? I do qualified plans. They had $700,000 of taxable earnings and they really wanted deduction. They had a tax bill where they were of $250,000. Excuse me. So we gave them actually a 412E3 plan with annuity only. We did not do life insurance in that plan. We just did annuity. That gave them a $405,000 contribution. So that was deductible. That reduced their taxable income to $295,000. That brought them below the threshold, so they regained their 199A deduction. Anybody who was paying attention on the last call will remember that. So that's another 20% deduction they got. Ultimately, we brought their tax bill down from $250,000 to $50,000. They were happy about that. Now, their plan here is to do this for 5 years. We are currently in year 4 with this client. At the end of the 5 years, they will have contributed, this money, this $405,000 every year. We will have saved them $996,000 in taxes. Between the two of them, their benefit in that plan, in the annuities, will be $2,068,000. We will then create a little 401k plan for them and roll that $2,068,000 into the 401k plan. Once it's in the 401k plan, we will move it all into insurance policies. Now, in this case, this family is very wealthy. The parents don't need the money. So we're going to buy the insurance on their children. Their children ages 20 and 24. The $2,068,000 we divided between the two of them, it buys a total of $23 million of death benefit between the two kids. We will pay for these policies over the 5 years. At the end of the 5th year, they're paid for, and we distribute them right to the parents. The parents are going to own these policies. They pay the tax. It's their money. So when we distribute the policies, we put $2,068,000 into the policies. The taxable value under that IRS market calculation is $1.4 million. So the tax bill on that distribution is $570,000. Now we saved this couple $996,000 in taxes putting the money in to the plan originally. They pay $570,000 in tax on the way out. So overall, we saved them $425,000 in taxes. Now, they now have these two policies. The parents own them. They have full access into the cash in those policies, tax-free. Excuse me, should they want to use it. They don't expect to ever touch these policies because of the amount of money that this family has. So when they pass away, ownership of the policies will go to the two children. Now, the two children will have the right to access the cash in those policies tax-free if they want to. They don't expect them to use the money either because they're going to be wealthy too. So what will happen is when those two children pass away, the death benefit will go to the grandchildren. We just looked ahead, we don't know, but if each of these kids died when they're age 80, the tax-free legacy that will go to the grandchildren is $48 million. All courtesy of grandma and grandpa's beginning this plan with this 10-year horizon. They created this tremendous wealth transfer. Now here's a similar client. We did the same strategy, but not everybody's so rich. So this was a gentleman who came to me with $1.2 million in his IRA. He's 64, but he was uninsurable. And he was not married, he was divorced, so he has 4 kids. So we divided his $1.2 million between the 4 kids. Here's one of them. We used $300,000 on each child. This child is 27 years old. And so here's what the tax picture looked like on that $300,000. If we had let that 300,000 stay in dad's IRA and let it grow out to age 90. The tax bill would be 396,000 on that account. If he did the Roth conversion, the tax bill would be 153,000. Using the life insurance with the market value calculation, the tax bill is 109. So it did still lower the tax bill, but look at the benefit side of the equation. Remember, the insurance is written here on the son. If the son dies when he's age 90, the death benefit to his beneficiaries is $8.2 million. Remember, we're only spending $300,000 here. He could take income from this policy. We started it in 5 years. I'm sorry, in 10 years when he's 37. He could take income every year. And dad would be able to take it first because dad will own this policy as long as he's alive. Every year from 37 to 100, this policy, we could pull out $27,733 tax-free for his entire lifetime. If he lives to age 90, we add all that up plus what the remaining death benefit is, and the policy is paid $3.4 million. The Roth, of course, we would have to empty 10 years after the father's death. It would pay $835,000, and the traditional IRA would pay $404,000. But let me show you the detail behind this because this is very telling. Here's the $300,000 in the IRA, right? We let it grow. We get to age 72, dad has to take his required minimum distributions. His first one is $17,000. He takes them, we assume he passed away at age 85, right? If he were to die at age 85, there'd be $472,913 left in the account. His son would inherit that. Under the current Secure Act rules, he could leave it in that account and let it grow for another 10 years. So if he does that, now it's grown to $697,000, and now he has to take it out, pay the tax, and he ends up inheriting $417,000. But instead, we took the $300,000 and we put life insurance on him. The initial death benefit of that policy is $2,850,000, which, by the way, the policy is dad's money. He'll own the policy, and he's also the beneficiary. So, you know, in the unfortunate event if his son were to die, dad will get the $2,850,000. Now, dad will own this policy for as long as he lives, and he'd have access to the cash if he wants it. He thinks he's not going to need it, and he doesn't have to take any required distributions anymore because it's not in the qualified account. So now if he dies at age 85, we had $427,000 left after the RMDs in the IRA. Here, the cash value of this policy, the cash surrender value, is $589,000, all available tax-free. If we follow out to that same 10-year horizon where his son would have had to have emptied that IRA account and end up inheriting $417,000, the cash value in this policy is $1,081,000, tax-free, available to the son, and he can use this money however and whenever he wants. Maybe it will be a legacy to his children, or maybe he'll use this cash to pay for their college education. He can do whatever he wants with the money. But in effect, we have leveraged his inheritance from being $417,000 to being a little over $1 million. So if you have someone who has money sitting in their qualified account, here are some questions you can ask them. You know, how much of your retirement account do you think will be going to taxes? Most people have not thought about this and thought this through. Do you want to leave more of your retirement account to your family or to the IRS? We think we know the answer to that question. Do you want to stretch your retirement account to leave a lasting legacy? Right? Before the Secure Act, we could have an IRA and have it inherited by our child, and they could stretch it out over their lifetime. They can't do that anymore with the IRA, whether it's traditional or Roth, but they can with the life insurance. Have you protected your retirement account from market risk? We know how the life insurance will improve that situation. How do you plan to get the money out without paying the highest possible tax? Because frankly, the IRS has written the rules to make you pay the highest possible tax. And are you prepared if you have a major health event? These are all easy questions you could ask somebody, and all questions that can raise issues that we can solve with this strategy. So to kind of step back from all the details, this is usually starts with a conversation about tax savings. You know, what's your plan for getting that money out and reducing that tax bill? But we can also help give people some peace of mind by reducing the market exposure and the market risk on that money, give them the flexibility to use the money when they want, how they want, and lastly, give them the added protection of those living benefits, which they don't currently have. And all this is done in a very safe way. This is very conservative. We're staying right in IRS safe harbor rules. We're not creating audit risk. The CPAs like it when they understand what we're doing because it really is very conservative. We're not doing anything high risk here. If anything, we're reducing risk for the client. So it's a winner on many counts for the client. And you just need to ask some basic questions to kind of open the door. So with that, I thank everybody for your attention. I will hold on if anybody, if we do have any questions, depending on what our time is. I don't have my watch in front of me, but I will stop talking. So somebody else.
Okay, Mary, great job as always. Andrew, do we have any, I know we're a little bit late, but I think this is worth the time spent. Do we have any questions that we need Mary for, or that maybe something we can't circle back with after, or you tell me, Andrew. Anything come up now?
Yeah. I got a good quick one here. A couple agents asked this. Can this strategy, Mary, be used for people under 59 and a half? So let's say you have somebody who's 50 or 55 and they have money in a qualified account. Can you take that money out early into your strategy and just incur a penalty? What's the process?
Yes, we can do it. We will incur the 10% penalty. However, usually what we're saving them in the long run in the increase in benefits, because also they're younger for buying the insurance, it'll leverage up the benefits. Comes out way ahead of the loss they paid by paying the extra 10%.
Okay, great. Andrew, any others? We have time for maybe one more.
Let me take a look here. Hold on a second.
And by the way, as he's looking, every single question will get answered as soon as we hang up. So I don't want you to think if we didn't pick you, you're just hanging in the air. We're going to circle back with every single person. So don't worry about that. Just trying to think of something that's common that we're seeing multiple agents ask the same question on.
Okay, I think... let's see. No, everything else we're going to have to get to after.
Okay. All right. No problem. We'll do that. We have just a few more slides and we'll end on time, which is always a nice thing. And then we'll, of course, have our question of the day. Okay, Mary, again, great stuff as always. And by the way, check out, we did a podcast together. We did probably 5 to 6 training webinars already. Keynote speaker at the Levinson Expo. You'll also see her on the Expo video, which came out awesome, my favorite one of all time. So you got to see that tonight. And let's go to the next slide here and talk about, now you're excited. I know a guy, I know a girl, I know a business owner, maybe even a CPA, right? We know it's a little bit of a conflict sometimes with a CPA being life insurance licensed. So they like to bring in an agent to handle. So you could be that guy or girl. So the opportunities are endless. And you're scratching your head saying, great, I want to get started. I want to talk to Mary. I have a case. What do I do? Okay, first off, now you do have to be active under Levinson. So what that means with the 2 carriers that she loves to use, okay, Whole Life and IUL with LSW and Lafayette, you do have to be appointed under us. If you already have a contract under another IMO, you transfer over to us. We match or most of the time beat your commissions plus free leads or cash with your first paid application. Okay, so we make it a win, 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 win. And then, obviously, once you're set up, we make the introduction call with Mary as long as you have a case, and then we go from there. So also, her books are available as well. We give these away if you leave a review or testimonial on our Facebook page, or they're also available for purchase. So that's totally up to you. What we're going to do in the thank you email today will include all of her material, all of the book information, an order form, basically, again, everything you need to get started, and the slide that you're looking at, which you can just jump on our website and follow those yellow arrows. And literally, it's 1, 2, 3. We make it very, very simple. Okay, now what I also wanted to speak about real quick is marketing material, right? So now you're set up with Levinson, let's say with LSW, and you want to start to get the word out. So we have all these pre-approved, pre-made marketing videos, e-blasts, we have blogs that you can leverage. I mean, everything's already done for you. We can even co-brand some of this stuff with your picture, your logo, your phone number, and now you just sprinkle this out to the masses, talk about it on YouTube or Facebook or LinkedIn, right? And get that phone to ring, and that's how you're going to find the perfect candidate, right, for her strategies. And I know I'm making it sound easy, but if you're networking and you have those great relationships, it is that easy, okay, literally. And again, average commission, 130, 140 grand, so well worth the 1 hour spent with us today, obviously. Okay, next slide up is Ringy. So Ringy also works hand in hand with her concept, okay? And I'm going to explain to you why, just layman's terms. Now, think about this for a second, okay? You're an agent out there and you're calling in from Lincoln, Nebraska, okay? And you love this concept and you're thinking, all right, now I got to find the right people that fit into this mold, right? You're sitting on, let's say, 1,000 prospects, leads, clients, maybe book of business, maybe orphans. Think about this, 1,000 contacts, okay, that are yours, friends, neighbors, all the above. Now what you can do, okay, as those leads, clients, prospects are sitting on a shelf collecting dust, imagine putting them into the Ringy CRM tool, or Sifter is what I call it, okay? So when you put in these 1,000 people into Ringy, you now turn on, let's say, the distribution solutions campaign, if you will, okay? And what Ringy is going to do, by the way, you're going to sit back and click a button. You don't do anything, okay? What Ringy is going to do is send out a series of emails, okay, of text messages. It's going to send out a calendar version, okay, where that's shared, where this client clicks to set up an appointment with you, and they can see the days and times that you have open or available, okay? And then you get a text saying, hey, Bill Levinson wants to talk about tax saving strategies tomorrow at 4 p.m. Click to accept. So this Ringy system is like your assistant on autopilot. It's going to send out a series of texts, emails, and even phone calls and voicemails if you wanted to, okay? All about this strategy. And you can set this up to hit these people 6 times, 7 times. Put it this way, by the time Ringy does its thing with your 1,000 prospects or clients or a combination, you're going to get a 5 to 10% response rate for people that want to hear more or set up an appointment with you. Okay, so rather than all of these contacts sitting on the shelf collecting dust year after year, you just turn, let's say, 50 to 100 of them into new active appointments because they just saw your marketing, okay? By the time they get hit 7, 8 times, they're going to say, Bill, either get me out of this damn program, or Bill, I want to talk more. What day and time works best? Or click on your calendar to set the appointment. It works that easily. And here is a perfect example. Let's look at that quick testimonial there right under our picture. So Ian is one of our top agents. You probably heard him on our podcast before in California. Okay. This was his comment to me as soon as he saw that we had a 30% co-op discount rate. So it comes out to $69 a month. But this is what he told me, okay? And he's probably on this call right now. I didn't even take a look yet. Never seen a CRM like this one before. I can't imagine any telesales agent not utilizing that local caller ID feature. Ringy is a beast, and their customer service is the best. Okay, and by the way, I didn't ask for that. That's what he told me. In fact, I asked him if I can use the testimonial. Then Charles, who is on the call right now from Illinois, listen to this. He uploads his 1,000 leads, neighbors, friends, okay, did the same thing. Within 48 hours, he had 17 appointments set, okay? Charles from Illinois, 17 appointments in 48 hours. These are real life agents like you all out in the field. Okay, the program works. I promise you. Okay, my promise, 5 to 10% return on whatever you put in the Ringy Sifter. Definitely worth your time. This is the 1 hour podcast we launched last week, and that's me, the CEO, and Carlos. So Bradley is the middle picture there, CEO, Carlos on the right. He runs sales and marketing, and then they have a complete turnkey support team that gets you up and running. I don't care if you're 17 years old or 78 years old. It doesn't matter. Once this is set up and everything's pre-made, you're off to the races, autopilot. That's it. And then you can focus on your day-to-day. Okay, what we also did is we want to make sure everyone is comfortable, right? So I told Bradley, the CEO, we need to put together a 4-part training series, okay, similar to what we just did with Mary, but with technology and the CRM tool. So imagine taking Mary's strategies, right, and now dripping out these marketing pieces to all of your potential prospects, okay? Look at the percentages. Look at the return rate. It's worth it. So anyway, part 1, 2, 3, and 4, we literally host these live over the next 6 months. So anyone that works for you, make sure you write it down, register, and we're all going to be on there live answering questions and making sure that Levinson agents are 100% comfortable with the platform, because I know when you are, you will be off to the races, okay? And the more product, more premium you write, obviously, that's how we make our money. So this is a win-win-win across the board. If you're sitting there and you're on all of our trainings and you're calling our 22 staff members all the time but not writing any business, obviously we're in the red, okay? So we're in this together with you. So any tools, platforms we think will help you, obviously we're going to share everything with you after we do our due diligence. That's exactly what Ringy's about. In fact, that's exactly what Distribution Solutions is about with Mary Reed. It's a win-win-win across the board. Okay, future training. So that's what you're on right now, the weekly training webinar series. And on the bottom there, we have a new concept, okay? It's not new to the industry, but new to Levinson, your family bank concept. So we have the creator that's going to be on the 19th for 1 hour with us. We are officially launching this to our field force. Right under that, we're going to talk about the top marketing opportunities for hybrid life and LTC products for 2022. That's on the 26th. And then, Andrew, before we put a bow on this, let's back up to the Expo video slide, which I ran right over as I was talking. My fault. But I think this is so important. So real fast, we're sending this out in the thank you email, and I want everyone to check it out. Why? Number one, it's our 50th anniversary here at Levinson, 1972 to 2022. So this expo was very, very special last month. And Oscar, our videographer, did an unbelievable job with the highlights video. I want every single one of you to check it out. Leave a comment on our Facebook page, and I send you Mary's prospecting book on us, okay? You have to be active with us. Active means at least one carrier appointment, and you have to, of course, have written at least one application, okay? I think that's fair. I send you the book on us. Done. Okay, last slide here in our question of the day. It's also our Positive Tuesday quote. So, real fast, this was Sunday, Formula One race, which, by the way, it was a crazy, crazy weekend in South Florida, okay, at the Kentucky Derby. I mean, we saw some unbelievable races, horse racing to car racing. This was our quote, and I love this quote, and I think it's so, so important when you're talking about any of this racing, any of these sales strategies. Life insurance, Formula One, doesn't make a difference. You can't succeed with others who don't appreciate how success looks on you, okay? Surround yourself with positivity. And anyone that's not about that, you get them out of your life. It's that simple. They're going to bring you down, okay? Very important stuff there on a personal level. Okay, question of the day. Make sure your little fingers are on your keyboard and you're ready to answer first and correctly. Quick question, okay? Then you win the Tablet 8 in Mary's prospecting book on us. You ready? Okay. I spoke about our agent testimonial using Ringy. Charles from Illinois, right? About 4.5 minutes ago. How many appointments did Charles get within 48 hours? I shared it with you all. How many appointments did Charles get, okay, by putting his 1,000 leads into Ringy? How many appointments did he set within 48 hours? He couldn't wait to share it with us. Tell me the magic number, you win. Andrew, do we have a winner today?
We do. Mike G. Mike G is the first.
Mike G, the answer was 17 appointments within 48 hours. Okay? The program works. Mike G, congrats. We will mail out your prizes, let's see, by Monday afternoon, the latest. Let's all have a great Thursday, okay? Keep your eyes open for our thank you email. Let's get started on the right foot. Get active with these companies, okay? Find the right candidate. Let's change your year for the better, okay? Good selling, and thank you again, everyone.